So, how does Michael define an order block? An order block is an area where price changes its delivery. In other words, if price was previously bullish, it becomes bearish, and if it was bearish, it becomes bullish. Now, which candle creates this shift? In a bearish trend, the last bullish candle, the final opposite colored candle before the move down, becomes your bearish order block. Why do we call it a bearish order block? Because when price returns to that area, we expect it to reject and move lower. Even though the candle itself is bullish and colored green, it's still considered a bearish order block because it causes a bearish reaction in the market. Inside a bearish order block, we focus on three important levels: the low of the candle, the open of the candle, the 50% level of the order block. We expect price to react from one of these three levels and continue moving in the intended direction. Another important point is the 50% level. If price comes into the order block and closes above the 50% level, it suggests that there may no longer be a significant sell order sitting in that area. For example, if I entered a short position from this order block and price closed above the 50% level while my stop loss was above the order block or above this red arrow, I would likely exit the trade early. Why? Because that tells me the area is no longer strong enough to push price lower, making the setup less reliable. Now let's look at another example. Here we have a bullish order block. If you have multiple consecutive bearish candles, like in this example where we have two bearish candles back to back, we consider the entire group of bearish candles as the order block, not just the last candle. So whenever you have 2 or 3 consecutive bearish candles, the whole range becomes the order block, not only the final candle. As you can see, price eventually moves through the order block. At that point, we know that a change has occurred. But when exactly do we confirm that change? We confirm it when price closes above the open of the order block. If we look at these two bearish candles, their open is right here. Once price closes above that open, which happens with this candle, the order block is officially formed, and we can say that a change in delivery has taken place. This means price delivery is shifting from bearish to bullish. After that, price comes back to the open of the order block, reacts from it, and then continues moving higher. Here as well, we have two bearish candles. Notice that once price closes above these candles right here, we have a change in state of delivery. That's our confirmation that price is likely to continue its bullish move. Then price comes back and taps the 50% level. We do allow with penetration below the 50% level. That's completely fine. What we don't allow is a candle close below the 50% level. For example, we're currently looking at the 1-hour Euro to US dollar chart. If a candle closes below the 50% level on this same time frame, and my stop loss is placed below the order block or below this arrow, I would manually close the trade. The reason is simple. I want to get out with a smaller loss. Whether it's 1 pip, 2 pips, or even half a pip less, it's still better than taking the full stop loss. After that, price comes back, reacts near the 50% level, and continues moving higher. This is another example of consecutive up candles. Now, if you've watched some other courses, you may have seen people only consider the very top candle as the order block. The problem with that approach is that price often never reaches that single candle, causing you to miss valid trading opportunities. That's why we treat the entire group of candles as the order block, not just the highest one. As you can see, price comes back close to the low of the order block, reacts from it, and then continues in the intended direction. Alright, let's look at another example. In this example, these bearish candles together form our order block. This is what we call consecutive down candles, multiple bearish candles forming one bullish order block. Now, why do we consider all bearish candles as part of the order block? Take a look at the time frame we're using. This is a 1-hour chart. If you switch over to the 4-hour time frame, you'll notice that these bearish candles are actually combined into a single 4-hour bearish candle. So, from a higher time frame perspective, this entire area represents one bearish candle and therefore one order block. That's why whenever you have multiple consecutive down close candles forming the same move, you should consider the entire group as the order block, not just the final candle. This approach keeps your analysis aligned across multiple time frames and helps you identify the true institutional order block area more accurately. Price returns to the zone and reacts from it. This time, price reacts from the high of the candle rather than the open. There's an important concept here. Whenever you have an order block and, inside that same order block, you also have an FVG, fair value gap, things work a little differently. Take a look at this example. We have an FVG sitting inside the order block. When price trades through the FVG, it will often continue deeper into the order block and react from the high of the candle rather than the open. So if you have an order block with an FVG inside it, and price has already filled the FVG, the high of the candle often becomes the highest probability entry point. In these situations, price frequently reacts from the high and may never reach the open or even the 50% level.